September 1st, 1998. Bank Negara, Malaysia fixes the ringgit at 3.80 to the US dollar. The same morning, Malaysian officials lock foreign portfolio capital inside the country for 12 months. No withdrawals, no conversions, no exit. Across the border, the International Monetary Fund is running the opposite program in Thailand, Indonesia, and South Korea. Rate hikes, austerity, open capital accounts. Malaysia refuses all three. This is not a story about defiance. It is a story about what happens when one finance ministry decides the standard prescription does not fit the patient. Rewind 12 months. In July of 1997, the ringgit trades near 2.50 to the dollar. By August of the following year, it is past 4.70. That is a currency losing almost half its value against the dollar in just over a year. The Kuala Lumpur Stock Exchange loses more than 75% of its value over the same window. Bank Negara's foreign reserves, which had stood above $30 billion in mid-1997, are draining fast, spent defending a currency that keeps falling anyway. Here is the mechanism nobody names properly in the news coverage from that year. Offshore ringgit trading through the Singapore CLOB market, the central limit order book. Malaysian shares and ringgit-denominated instruments were being cleared and settled in Singapore, entirely outside Bank Negara's jurisdiction. Hedge funds could borrow ringgit offshore, short it, and settle the trade without ever touching Malaysia's domestic banking system. Bank Negara could raise interest rates, could burn reserves defending the peg, and still had no legal reach into a settlement market sitting across the strait. The central bank was fighting a currency war with one hand tied, because the battlefield itself was offshore. Consider what that offshore architecture actually meant in practice. A hedge fund in Singapore, London, or New York did not need a Malaysian bank account, a Malaysian broker, or a single ringgit sourced from inside Malaysia's borders to bet against the currency. It could borrow ringgit from another offshore counterparty, sell it forward, and close the position entirely within a settlement system Bank Negara had no subpoena power over, no reporting requirement into, no supervisory relationship with whatsoever. This is the detail that turns a currency crisis into something closer to a jurisdictional ambush. Malaysia was not simply losing a battle against market sentiment. It was losing a battle it could not see, fought on an exchange it did not regulate, using its own currency as the weapon. Every ringgit sold short in Singapore added pressure onto the peg without a single transaction ever crossing a border Malaysian customs or banking law could touch. Next door, the counterfactual was already running in real time. Thailand had signed its IMF program in August of 1997. Indonesia followed in November. South Korea in December. All three accepted the same core terms: raise interest rates to defend the currency, cut government spending, let insolvent banks fail. Indonesia's rupiah kept falling anyway. Thailand's economy contracted by more than 10% in 1998. The playbook everyone assumed was mandatory was not preventing collapse. It was managing the pace of it. Look closer at Indonesia specifically, because it is the clearest cautionary case sitting right beside Malaysia's experiment. Jakarta closed 16 banks in November of 1997 under IMF direction, intended as a confidence-building purge of insolvent institutions. Instead, depositors panicked, assuming no bank was safe if regulators would shutter institutions without warning, and pulled cash out of the entire banking system rather than just the condemned 16. The rupiah, already falling, accelerated its collapse. By January of 1998, it had lost more than 70% of its value against the dollar from its pre-crisis level. The IMF prescription, applied with total fidelity, did not stabilize confidence. It detonated it. Malaysia watched this unfold from across the South China Sea before making its own decision in September. So, what did Malaysia actually build on September 1st? 3 components, engineered together, not separately. First, the fixed exchange rate, Ringgit locked at 3.80 to the dollar, full stop, no band, no crawl. Second, a ban on offshore Ringgit trading, which killed the Singapore CLOB market's ability to settle Malaysian Ringgit positions, the exact mechanism that had let capital flee without Bank Negara's knowledge. Third, a 12-month lock-in on portfolio capital already inside Malaysia, meaning foreign holders of Ringgit-denominated assets could not repatriate their capital until September of 1999. Foreign direct investment and trade settlement flows were carved out entirely, untouched, unrestricted. This was not a closed economy. It was an economy with one specific valve welded shut: short-term portfolio flight. The precision of that carve-out deserves more attention than it usually gets. A factory in Penang assembling semiconductors for export, financed by foreign direct investment, could still repatriate profits, still import components, still settle invoices in dollars without friction. A hedge fund holding Ringgit-denominated bonds purchased 6 months earlier for a quick yield trade could not touch its position for a year. Malaysia's architects were not attempting to insulate the country from global capital as a category. They were attempting to distinguish between capital that had come to build something and capital that had come to extract a spread and leave. That distinction, productive capital versus speculative capital, is the entire philosophical spine of the September 1st program, and it is precisely the distinction the standard IMF capital account liberalization framework refuses to draw. Why could Malaysia do this and not, say, Indonesia? 3 structural facts. Malaysia's current account moved into surplus in 1998, meaning it did not need continuous foreign capital inflows to fund imports. Malaysia's external debt was proportionally lower and more corporate, less short-term dollar-denominated sovereign and bank debt than Thailand or Korea were carrying. And Bank Negara Malaysia, as an institution, had the enforcement infrastructure, capital account reporting, banking sector oversight, a functioning tax and customs apparatus, to actually police a closed capital account without the whole system collapsing into a black market overnight. This was Mahathir Mohamad's political decision. It was Bank Negara's and the Ministry of Finance's technical architecture. 2 different actors, 2 different functions, 1 outcome. There is a 4th structural fact that gets less airtime. Malaysia's domestic bond market and banking system were denominated overwhelmingly in ringgit, not dollars. When a currency collapses, the countries that suffer catastrophic balance sheet destruction are the ones where corporations and banks borrowed in dollars and earned revenue in local currency. Every point of devaluation directly inflates the real debt burden. Malaysia had comparatively less of this currency mismatch baked into its corporate sector. That meant the devaluation, brutal as it was, did not automatically trigger a wave of corporate defaults the way it did in South Korea, where chaebols carrying dollar debt were mechanically bankrupted by the won's collapse. Malaysia had room to stabilize the currency without simultaneously needing to manage a corporate insolvency wave caused by the currency's prior fall. This mechanism repeats more than most people realize. Subscribe if you want to see it coming next time. What the peg and the lock-in actually purchased was time, 18 months, roughly, before the controls were scheduled to unwind. During that window, Malaysia stood up two vehicles that do not exist in most crisis responses: Dana Harta, an asset management company built specifically to strip non-performing loans out of the banking system, and Dana Modal, built to recapitalize the banks directly with fresh capital. Compare that to Thailand and Indonesia, where IMF conditionality forced immediate bank closures and higher interest rates precisely while their banking systems were hemorrhaging. Malaysia did the reverse. With the currency fixed and capital locked in, Bank Negara cut domestic interest rates to stimulate the economy instead of raising them to defend the ringgit. That is the exact inversion of every IMF program running concurrently in the region. Dana Harta, in particular, is worth sitting with because its mechanics reveal the entire logic of the Malaysian approach in miniature. It purchased non-performing loans from banks at a discount determined by independent valuation, moved them off bank balance sheets entirely, and then worked those bad loans out over years, restructuring, foreclosing, or selling collateral, insulated from the day-to-day panic of the banking sector. Banks, freed from the weight of bad loans, could resume lending almost immediately, rather than spending years frozen under the dead weight of assets nobody could price. Thailand and Indonesia, operating under IMF conditionality, did not have the fiscal room or the political cover to fund an equivalent vehicle at the same scale, at the same speed, because IMF programs were simultaneously demanding fiscal austerity from the same governments that would have needed to capitalize such an entity. But the detail that actually separates Malaysia's case from the long, ugly history of failed capital controls elsewhere is smaller than the headline. The controls were built with an exit date from the start. Not indefinite, not open-ended. 12 months, then a graduated exit tax replacing the outright lock, then further liberalization through 1999 and 2000. Capital controls that never expire become currency black markets and capital flight through other channels. Malaysia's were structured from day one to dissolve on a schedule. None of this was free. Foreign portfolio investors holding ringgit assets on September 1, 1998, were locked out of their own capital for a full year, absorbing losses they could not exit even if they wanted to. Morgan Stanley Capital International pulled Malaysia from its emerging markets index in September of 1998, a direct consequence of the capital controls making the market untradable by index standards. Malaysia would carry an elevated risk premium in international capital markets for years afterward, the cost of having proven it would close the exit door if conditions warranted it. Domestic Malaysian savers, meanwhile, absorbed the ringgit's devaluation just like everyone else. The peg fixed the exchange rate going forward. It did not reverse the losses already taken between 2.50 and 4.70. Nobody in this story recovers the money. They redistribute where the loss lands. There is also a quieter cost that rarely makes the retrospectives, the signal sent to every future foreign investor evaluating Malaysia as a destination for capital. Trust in an open capital account is not a renewable resource that resets to zero once controls are lifted. Institutional investors who lived through the 12-month lock-in priced Malaysia differently for a decade afterward, demanding a higher yield to compensate for the demonstrated willingness of the state to trap capital inside its borders when conditions turned adverse. That premium is invisible in most retellings of this story, but it shows up quietly in every bond issuance, every equity raise, every foreign investment decision Malaysia made for years after the crisis technically ended. Today, the ringgit floats under a managed regime, not a hard peg. Bank Negara intervenes selectively, but 3.80 is long gone as an active target. Malaysia never fully abandoned the underlying instrument either. Selective capital controls have resurfaced in Malaysian policy discussions in the years since, treated as an available tool rather than a historical relic. But the 1998 model does not transplant cleanly. It depended entirely on Bank Negara's institutional credibility, a current account surplus, and comparatively low external dollar debt. A country carrying Indonesia's 1998 debt profile, attempting the same lock-in, risks a currency collapsing into a parallel black market the moment capital cannot legally exit, because there is no surplus, no reserve cushion, and no institution capable of enforcing the wall. Capital controls function only as a bridge with a pre-engineered exit. They do not function as a foundation.